I think, firstly, understanding that in real estate, you have to apply a value of time to everything makes an enormous difference.
Could you just talk to us about the importance of time, diversification, liquidity, and being out of debt and being able to buy real estate whenever you want, all tax deferred? What would that mean for you and for your investors or anyone that's listened to the show?
I think it's huge. I find that one thing investors that are active in real estate, they one of the things that they consistently don't seem to do is to weigh different investments based on their post-tax benefits and also based on the value of time. In the industry, we use a methodology called IRR or XIRR to calculate the value of your time and say, you don't just want to look at, whether my buck is becoming $2. I want to see whether it's becoming $2 over a certain amount of time, right? And and how much am I deferring cash flow? Is it giving me $2 at the very end, or is it giving me $2 all along so I can run my life with it? So I think, firstly, understanding that in real estate you have to apply a value of time to everything makes an enormous difference, right? And there's projects out there that we run where we don't give you any liquidity, any cash flow until the end. And in my mind, the projects that we have where we do give you liquidity all along are better. I can't argue with that. They are absolutely better. So calculating liquidity, looking at the time value is very key. And also constantly, continuously, especially in California, calculating your post-tax gains are very good. I'd like to challenge you investors. Let's say you know about 5 different kinds of investors, some investments. So maybe like buying a single family, buying a fourplex, investing in a syndication, doing private lending, right? Let's take any 5 representative things that you might want to invest in. And I want you to create a thought exercise that I think will really blow your mind. I want you to go into Excel, hopefully, and you know how to play with Excel based on a basis level. And I want you to take a 30-year time frame for each of those investments. Now, some of those investments, like private lending, let's say on average you're doing it 1 time a year. Well, then you're going to be repeating it a number of times to get to 30 years. Some other investments like DSTs you might hold for 5 years or 10 years. In that case, you're going to be repeating them less often, right? So some are more repeated, some are less repeated. But every time you exit a project, whether it's a 1-year investment or a 5-year investment, make sure that your calculation includes the taxes that you paid, right? And if you're rolling it using 1031, then you're not paying taxes. Good for you, right? So it's going to go up a little bit faster. So maybe if you're doing single family, you can do one where you're selling it, one that you're rolling it to 1031. And I think if you do an exercise for what happens to your wealth, your long-term wealth building in these different situations, I guarantee that even if you have done real estate for 10 years, you're going to be in for some interesting shocks. There's going to be things there where you're like, so this investment I thought was the worst of them all. But by the time I understood the value of money, by the time I understood that and by the way, you also have to account for gaps. You can't say silly things like, well, I sold my syndication share or my DST share on this day, and the very next day I reinvested. No, that's not reasonable. There's going to be a gap in the middle, right? So longer term investments may have a lower return, but you don't have gaps in the middle. When you do this thought exercise, it's going to make you a much better investor because by definition, you're going to look at the 3 or 4 things that swing the needle a lot that people don't think about. 1, time value of money. 2nd, the taxation, right, which is such a big deal, especially in California. It's a huge, huge deal. It changes your mindset completely. And then overall wealth building over time, right? So the people ask me, Neil, you're a multifamily guy. Is multifamily the best wealth building strategy over a 30-year time frame? Now, notice Brett, somebody's asking me a very specific question, right? So I think multifamily is great, but I think the answer to his question, this was a person that asked me this question, very experienced investor. He said, over a 30-year time frame, what investment is the best? And I said, I happen to have done this thought exercise. So of course I brag about everything I've just said for about 5 minutes. And then I say, in that exercise, the winner was not multifamily. The winner was fourplexes that people bought and kept for 30 years and refinanced every 6 years. And every 6 years, they took the proceeds and they reinvested into another fourplex, just like the first one. And I assume that the price is increasing over time. So obviously, when you're taking that money out, now the price has gone up. So if I extrapolate that one over 30 years, it beats the shit out of everything else for one simple reason. You never paid any taxes on that 30 years. You got on $1 million property, you got a massive amount of depreciation, right? And you use that depreciation over 30 years. I did straight line instead of doing cost segregation. And then the equity that you built up over those 30 years, which for one fourplex might be 3.5 million roughly, because you're paying down the mortgage over 30 years, right? So at the end of 30 years, the property is free and clear. You never paid taxes on that either, because when you died, your kids, the basis got adjusted for them. So when I look at that from a 30-year perspective, it beat the shit out of what I do. But not a lot of people have that level of patience, and not a lot of people know that every 6 years in that strategy, you got to reinvest, take all of your equity out, and rinse repeat. So I think these kinds of thought experiments are incredibly beneficial. And for years, people, when I would tell them this, people would say, so are you selling fourplexes? The answer is no. And they're like, well, why don't you sell fourplexes? So it took me 5 or 6 years, but I finally got to the point where I now build and sell fourplexes to investors as well. It's not a big part of our business. It's a small part. Not everybody can afford a fourplex, right? And why fourplexes? Because single family just doesn't scale well. So I love the fact that you got 4 tenants, and when you lose one, you're the other 3 are still paying the mortgage. So I adore that.
Amazing. So much there. I absolutely love it. And it's fascinating to again become a mad scientist of multifamily investing, but it's really becoming a mad scientist of numbers, of data, of strategy, right? And then applying that to investing in real estate or whatever investments you may be going into. The other thought too is there's a couple things with the 1031 exchange that people may forgotten about, but it's been basically limited to just investment real estate. It doesn't apply to high-end primary homes. We just did an $8.3 million deal in Palo Alto for a primary homeowner, helping defer a bunch of tax. We just did a $2.6 million business sale out of Alabama. Right. And what's cool is now they've taken the funds, and one of them is building 72 units of multifamily in Tennessee, all tax deferred. So the idea of instead of refi and either go build or buy something else and get more, the Deferred Sales Trust, you can sell, move it in there, and use the funds that you would have paid in tax to go build 72 units, right? All of a sudden you get a brand new depreciation.
That's a very powerful strategy. To me, I think that is, in my mind, not a very common use of the DST, but unquestionably the best use of the DST. To be able to put that money in and then go build something, give yourself time to create an enormous amount of value, which you wouldn't have created otherwise, right?
Correct.
Because you didn't have access to that money, right? That
100%.
is incredibly powerful, because what you're doing there is force multiplier. You're taking that taxation benefit and truly multiplying it by creating more value with new construction.
Exactly.